Hey, Jill, how are you doing?
I'm great. How are you this morning?
Oh, I'm doing good. I'm so tired of drafting slats and doing calculations, but I'm glad the new software will probably replace me to some extent.
It's very useful.
Yes, it is. Can you believe that people watch these crazy, terrible videos?
I know CPAs are trying to get the rest of their hours before June 30th, like myself.
I know. They're getting so much stuff it could make their heads spin. I guess I'm slow and arthritic. Anyway, I'll get Alan and we'll start the presentation. I certainly hope it's better than last week's. Oh, thanks for saying that. Okay, sorry. All right. Welcome to part 3 of Evaluating Estate Tax Techniques. I am here with Jill Ashley, a brilliant CPA, financial advisor, and law student who came to our office because she likes to suffer. And when she got to our office, we started talking about the Estate View software that I've been developing since I was 12 years old. And she said, no, this actually could be much better than it is now. And we've come from mediocre to somewhat better in the official Jill Ashley ratings. So this is a CPA Academy presentation, believe it or not, sorry to disappoint you. And there is the CPA Academy login that you would have used if you are going to get continuing education credit as a CPA or a registered advisor or a forestry officer. If you did not come through that website, then you probably came through Mars, and not so much, except if you're a Florida lawyer, you will get credit for this, whether you deserve it or not. If you have any questions, ask your dog. But if you want to try us, Jill will answer all your questions. Just click on the inverted pyramid and then give us really hard questions like mitigation of the statute of limitations and reverse triangular mergers. Jill knows all that stuff. Part 1 and part 2 will be much better than part 3 because we've already recorded them. You can go to our website or you can go to our YouTube site, search Gassman YouTube, it'll come up, and then you can watch these in an unlimited fashion. So, and that's what you're looking for, part 1, part 2. If you want to use Estate View, I'm going to tell you a secret. Don't tell anyone. This is a big, big secret. It's free for now, and you go put in your browser estateview.link, has nothing to do with sausage, and then your email address is test@test.com, and your password is test. Now, don't tell anyone. This is for you only and for no one else, but we would hope you would try to use the software as best you can. So I asked Jill and Joey, our 2 summer interns who are working for not so free, to give us a scenario of what someone would do if they had a $70 million estate, which is a $10 million home, just like the home you guys are all sitting in, and a $60 million of investments, and they are only willing to do something with 10 million, and they don't necessarily want to give it away. So they want to know, what can I do with $10 million? Now, the first thing that comes to mind is you could pay $10 million in professional fees. Now, that could be divided, $5 million for your lawyer, $5 million for your CPA. That will reduce your estate by $10 million. It will save you at least $4 million in estate tax and get you a deduction for what's reasonable and necessary. So it'll also get you a $600 tax deduction. But assuming that you don't want to do that and you want to join the estate planning club, we ran the following scenarios to talk about possible estate tax savings. So you've got John Q. Public, and I got it wrong. He only has 60 million in assets, hardly worth talking to. He's going to make a $10 million transfer. All of his assets are magically going to grow at 6% a year. He's going to do his thing, in whatever it is, through age 80, and then for the most part, and he's going to die at age 90, a very happy person. And if he does no estate tax planning whatsoever, he will leave 171,204,000, pay federal estate tax of 68,481,000, and there were no estate tax savings. So we picture that for John Q. Public here. We show his residence at 10 million, growing at 7% a year. We show his investments at 50 million, growing at 7 million a year, net of fees. And we then show him the bad news, 68,481,888, unless he would like to leave all of that to the Gassman Charitable Foundation, where Jill and I will administer it for charitable purposes, and there will be no estate tax. And if that's what you're going to do, the webinar is over. You don't have to do anything further. All right. So Jill, do you want to walk us through the first scenario, which is making an irrevocable gift?
So a lot of wealthy families will choose to make their gift instead of directly to beneficiaries. Either they're too young, or they're not wise with their spending, or there's a risk of divorce and those assets being transferred outside the family. So they'll use a irrevocable gift trust to receive the gift, and then the trustee is in charge of making distributions to the kids. What else can I say about that, Alan? You can discount assets to put into that trust. So if there's an LLC owning partial interests of real property, income producing property or businesses, you can get more bang for your buck by putting in a discounted gift. It's kind of just a general, planning opportunity. It's like the first step to slow down distributions.
Right. Okay. By the way, Josh, I'm getting a lot of people saying they're not able to hear us.
Yeah, I've checked. We got audio.
Usually people are happy when they can't hear us, but some people are unhappy. I never understood that. Okay. But Susan can hear us, so we're going forward.
Yeah.
So let's talk a little bit about this gift, how we show it to a client. After the gift, there's $10 million in an irrevocable trust. It grows at 7% a year. In 20 years, the rule of 72 proves itself right. It doubles in value once, it doubles in value twice. It's at $42 million on the second death. That money is creditor proof and never subject to estate tax. The estate tax goes down to $59 million, and John Q. Public's descendants are also happy that John Q. Public did it. Now, one nice thing about the gift trust is that it doesn't pay income taxes. So in the first year, this trust has dividends, it has interest, it has rent. And who pays the taxes? John Q. Public. The gifting trust doesn't, if he has retained the right to replace trust assets with assets of equal value under Internal Revenue Code section 645(5) in parentheses. So another thing is, what should he put in the gifting trust? And the answer is whatever is going to earn the most or grow the fastest. If he told us that he had a $10 million, or let's say a $13 million S corporation, earning $500,000 a year and going up in value by 7% a year, well, then of course we would put that in and the savings would be greater. But then he says, what can we do even better than that? Well, we could put the $10 million into an LLC, transfer 99% non-voting member interest to the LLC, and now, instead of using $10 million of his exemption, he only uses $7 million. So the estate tax is a little bit less. Is that right, Jill?
That is correct.
Okay. Now, if he had been willing to make a $14 million transfer, we could have had him put $14 million into an LLC and then transfer the 99% non-voting member interest of $14 million into the gift trust, call it a $10 million gift, file a gift tax return. The IRS only has 3 years to contest it if the return is thoroughly prepared with a proper valuation report. And then he would have in that gift trust 14 times 2 is 28 times 2 is 56 million. And that would save another $7 million in estate tax, but he didn't want to do it, so we didn't do it. Okay, so there you've got no planning, estate tax 68 million, gifting trust planning 58 million, and 30% discount, a little bit less in estate tax. You're only saving 40% of the 3 million. All right.
Should we mention the crummy trust provisions that we need to do to make it qualify as a current gift? We should, you can either use your annual exemption as the slide there shows, or you can make a large lump sum, one time and use your lifetime exemption before that might go down. But the crummy provisions allow you from that Crummy versus Commissioner tax court case to allow the beneficiaries about 60 days to withdraw funds that you've made into the, that you've contributed to the trust in order to qualify it as a current gift. So that's what keeps it out of the estate.
So really, so if he has one child and he puts the $1 million in, then he's only used 983 million of his exemption because 17 doesn't account. So and if he has 100 descendants, and we do have clients that have over 100 descendants, then 100 multiplied by 17, that's $1.7 million a year he could put in that wouldn't even count. So instead of putting 10 in, he should put $1.7 million a year in for 6 or 7 years, and he would come out ahead. So start having a lot of babies if you want to do good estate tax planning. So Jill, next we talk about an installment sale. Do you want to give us a brief rundown on what an installment sale is?
So it's a conventional loan, and it doesn't have to be between related parties like some of our other later examples. But again, you can use this strategy to, it's not going to be considered a gift because it's a sale. And you can use this strategy to transfer discounted assets. So income producing property, collections, anything that produces income, and business interests or partial interests in LLC units that you can transfer. So it gives the advantage of being able to remove a larger amount out of the estate in exchange for a promissory note. It'll use, I believe, the AFR rates. So loans will use the AFR rates as opposed to the charitable strategies that we talk about later. Use any split interest trust. They use the 75-20 rate, which is 120% of the midterm AFR, which we'll probably get into. I think there's a slide on that just for your reference.
Okay, so in this situation, what he does is he sets up an irrevocable trust, just like the gifting trust. It's the same trust, and he gives a $750,000 gift. He only uses $750,000 of his $12,920,000 exemption, and then he transfers $9,250,000 in exchange for a long-term note at 3.69% interest, which is the lowest rate you could use right now. That's the long-term applicable federal rate, semi-annually compounded, even though he doesn't have to compound it semi-annually. This is an interest-only note, so he's going to get back interest of what, about $270,000 or maybe $250,000 a year. And in the meantime, these assets are going to grow. And in 20 years, he has $14 million in the gift trust, even though he only used 750,000 of his exemption. So the estate tax is down to 63 million. Now, and by the way, you can do all these calculations on the software. But what if he took a 30% discount? So he put the $9,250,000 of assets into an LLC. He waited 35 days, then he sold the 99% non-voting member interest for a $6,475,000 note instead of a $10 million note. Now, in 20 years, that trust has a $20 million net worth based upon a $750,000 gift. Sounds like a no-brainer to me. The estate tax is down to $60 million. The next thing he said was, but I heard I could make the note self-canceling, so if I die before the note's paid in full, it goes away. And how would that work? So what we did there was we said, okay, you'll do the $10 million sale with a 30% discount, but the note now is going to have to bear interest at 7.73%, and it will cancel if you die during the 20 years. Well, he dies at the end of the 20th year. The note doesn't help him. The estate tax is higher than it would have been because of the higher interest rates he gets. But on the other hand, if he dies in year 19, then the estate tax goes down. It would be best for him to die in year 3. Then the estate tax would really go down. So you see here the different scenarios we're covering, and you could take the video of this, and you could go ahead and do all of these calculations on the Estate View software and also variations to get a good feel for what's going on. So now we're going to do our first polling question. And if you're a pole vaulter, you're definitely going to get this right, or if you grew up in Poland. Otherwise, the rest of us, we have to listen very carefully to the question. Would you like to beta test our Estate View software? A, yes. B, no, because I don't like beta fish. C, no, but I do like beta fish. D, I'd rather buy another set of encyclopedias. Or E, I'd rather fish off a bridge in the Sahara Desert. So I can't tell you what the correct answer would be here, but I'm not a beta fish either. Josh, let me know when we can go to the next. Okay. Jill, anything that you would add, subtract, multiply, or divide based on what we've covered so far?
Add a little bit of color to the self-canceling installment note. So I just, in case anybody isn't familiar with it, we talked about a premium on the interest rate. So the deal is to make it not a gift for the amount that cancels in case the person dies during the term and is extinguished and there's no balance due and it's not included in the estate. The trade-off on that is that you have to set up the note so that it either has a premium applied to the interest rate or to the principal. You might start with the interest rate, and then, using the calculator, depending on the age and the mortality and the 75/20 rate that you have to use, if that creates a usurious interest rate, then you have to instead apply a premium to the principal of the note to begin with at inception. And that qualifies it to not count as a gift, not be a disguised gift, but to be an actual bona fide sale. The risk of using those is, you have to know your client and their health and their age and mortality, likeliness. The risk is that if you're forced to pay a premium on this note, whether it's principal or interest, and the risk is if that person lives a lot longer than the normal life expectancy, then you're adding more to the estate. So basically you're reversing the whole point. And so that's just something to consider with each client.
So I went to the Estate View calculator for self-canceling installment notes. The 75/20 rate is 4.2%, which the computer knows. The client is 70 years old. His life expectancy is 15.4 years. So if the note goes beyond 15.4 years, the IRS says that it has to be treated like a private annuity and other rules apply. So if I put the note at 15 years, that's probably what most people are going to do. And this shows me that the applicable federal rate, 3.75%, my interest rate premium, 4.22%, my total interest rate, almost 8%. But in this scenario, the estate tax savings can be considerable if we're lucky enough to have him die early. Now, one thing I want to show you, thank you. You're like saying, yeah, let him die early. That's a good idea. Okay, now what if I want to show a different scenario? Well, if I just click the buttons, like if I want to show a 10-year term, I just click the buttons and it shows me that, but I want to remember it. So I go back to 15 here and I click here, duplicate. Now this has nothing to do with playing bridge. I click duplicate and it just started a second skin with the same exact information here you see in line 2. But with this second one, I'm on skin 2, now I can show 14 years or 10 years. And this will show me that with a 10-year term versus a 15, my estate tax savings in this scenario are a little bit higher. Is it worth going a 10-year knowing that he might die during the 10th? That's what you have to decide. But if I want to add a fresh new skin, I would click here for a third skin and it starts from scratch. But if I want to duplicate a prior one, I click here. And then I have spreadsheets I can look at for each of them. I click here, I get the spreadsheet, and I click here and it exports the given spreadsheet to an Excel spreadsheet that I can then do more on. So that kind of shows you a little bit of how the software works. So let's go ahead and get the second polling question out of the way, because there it is. There's 4 of them in total, and if you're not getting continuing education, you don't have to answer it. How are you involved in estate planning? A, as an advisor, B, your own planning, C, both of the above, or D, I signed up to the wrong webinar. And D is probably the right answer for a lot of you, judging the questions that we're getting. All right. And if you're still not hearing, then you're in a real pickle. It's a pickled hearing. All right. Jill, we gave a webinar for the Kettering Hospital System this week, and I asked you, how does a Cupert work? And the answer was so good that we're going to write an article from that answer. So I'm going to ask you again, but this time go at 3/4 speed. And if you can, make every main point rhyme.
Okay. Just like at work. Okay. So qualified personal residence trust. It is a way for couples or individuals to remove the value of their home from their estate, put it into a trust. It can be discounted for partial interest if spouses are going to each contribute 50%, their own portion of the share. You can use your first or second or both, first and second primary residence and secondary residence. You can take discounts. So basically it is a gift. It is going to use part of your lifetime exemption for the actuarial amount that of the term of the trust that you are using it as your residence. At the end of the term, it actually passes to beneficiaries, and you, the owners of the house, start paying rent. You can choose to pay rent or not, but if you are really trying to reduce your estate, you can pay rent as a percentage of the value of the house. And then we have some guidance on how to calculate, fair rental amounts. But if you pay rent, then that further reduces your estate, and then it will pass to beneficiaries without any estate tax. It'll be excluded from your estate. What did I say that was so good about that? Okay, so here's the thing. I used to think when I first learned about these that you were tied into the same house for the rest of your life. And I thought, well, not everybody wants to live in the same house. As you get older, you might want to downsize, you might want to sell it. So You can sell the house, or the trust actually sells the house, and the trust receives the proceeds from that sale. You have up to 2 years to replace that with another residence. And if you replace it with a lower cost, then the excess proceeds are in the trust but can be converted to a GRAT to pay that owner a grantor retained annuity trust for the rest of that term. Or if you don't replace the house, then the proceeds must be distributed or paid in the form of a GRAT for the remainder of the term that the trust was actually set up for. Still passes to beneficiaries at the end. Let's see, if the grantor dies before the end of that term though, the date of death value of the assets in the trust are pulled back into the estate. So that's one risk, but a remedy could be if there is a surviving spouse, you can that decedent, the decedent's estate can leave that to a surviving spouse for the unlimited marital deduction. And then another option always is to have term life insurance covering the term of that trust so that, the insurance would pay any estate tax that might be due. So did I cover everything on that? We talked about spouses can.
That was really good. That was very good. Josh, I want to take the transcript from that and send it to all the attendees later on today. That was excellent. Very good. So let's just look at some numbers. Well, first of all, here's a graphic. And thank you so much for this graphic, Jill. And our goal is pretty soon the software, when you click on show graphic, it'll show the specific proposal you have with this picture.
Okay, we don't see the pictures, or I don't. Anyway.
Oh, I'm sorry. Let me go back to share screen.
There you go.
There you go. All right, so this is actually Jill's house. It's a 10,000 square foot house on the Gulf of Mexico with a pool and a cigarette boat. So it's worth $10 million. And Jill puts this into the Cupert. And if you could imagine that she was age 70, which certainly is not the case, she would only be using 4.8 million of her 10 million exemption. Yet, if she lives 20 years, this thing is out of her estate for estate tax purposes. Now, if she dies during the term, the exemption is restored. So the home is still in her estate if she dies during the term. That's not good, but the exemption is restored. And then let's say that it's a 20-year Cupert, and in 10 years, she sells it and decides to live somewhere else. The Cupert could buy her a replacement property, as she said, or it could start giving her a stream of payments. And we'll show you how that stream of payments is calculated in a little while. Or if she moves out and somebody's, then it can be held there. Now, in our example, it's only a 10-year term. So the 70-year-old puts the home into the Cupert, only has the right there to live there rent-free for 10 years. After the 10th year, it's out of the estate. And if you want to continue to use it, you may have to pay rent. And that rent further reduces your estate. Now, if Jill had 2 children and she wanted to give the Cupert half to a trust for Jill and child 1, half to a trust for Jill and child 2, well, what is half of a $10 million house worth? Well, I don't know about you, but I would not pay $5 million for half of a $10 million house. Maybe I would pay $4 million. So just taking a 15% discount reduces the amount of the gift tax exemption taken. And for this and other reasons, when you have a married couple, we would typically have half of the house put by spouse 1 into a Cupert that will benefit spouse 2 for health, education, maintenance, and support and the common descendants, and be redirectable by spouse 2. And then spouse 1, and then the other Cupert formed by spouse 2 would typically only benefit the descendants because of the reciprocal trust doctrine. But I had a meeting on Thursday with a longtime client, and we put a lot into a Cupert, and it turned out that he spent his money a lot faster than we thought. And at first we said, uh-oh, you may run out of money. But he said, wait a minute, didn't we do 2 Cuperts, and half of that house is in my wife's Cupert, and that can pay half of our living expenses for the rest of our lives? And I said, oh yeah, I forgot about that. And he sent me a bill. But everybody felt a lot better, and now they'll sell the house, and millions of dollars will go into Cupert 1, which can be held for her health, education, maintenance, and support. So we have the examples here that you can look at. But I think it's probably more fun to show you the software. So I'll go to Calculator, Cupert, and I'll say a 70-year-old with a 10-year term, and this 70-year-old will live for 20 years. Let me find where the 20 years is. Projected rate of age 90. Got it there. All right, so across the top here, I know that the probability of a 70-year-old living to 80 is 68%, but this is a standard life probability table, which includes smokers and people who are not of higher economic means and typically don't have as good medicine, typically don't take as good care of themselves. And their liquor is not as high quality either. So the amount of the gift here is $900,000. And did I go to Cupert? Yep. Now, what is this $158,000? This $158,000 is, oh, and by the way, it's only $1 million home or a $10 million home. So sorry about that. I'll take this to
Also,
10 million.
Alan, you can make more columns show up if you want to show them right under where it says Cupert summaries, that they can put more columns to show more information at that the top left, Cupert summary. Yeah.
Yep. All right. So here's what you have. You have a $10 million home, $4.5 million gift, annuity due on sale, $790. And here's what happens. At the end of the 10th year, the home's worth $16 million. You start getting rent at 7%, and the Cupert is worth $36 million at age 90. So that's the first Cupert. Now let's duplicate that Cupert, and let's see what would happen if we just use a 7-year term. If we just use a 7-year term, then he has an 80% chance of living that long, and the tax savings comes out to a little bit less, but not so much. Now, what is this annuity due on sale? This is if he sells the house during the 7-year term, and doesn't replace it, then he will receive a check for $744,935 a year for the remainder of the term. Something else we've added to the software that you may not have seen yet is that you can do a 2-life Cupert. So I'll go ahead and duplicate this. And let's say he's married to a 60-year-old. So we have a second life, and the second life is 60 years old. So now it's still a 7-year Cupert, but the chances of living are 98%. There's a 98% chance this Cupert's going to work. And the annuity on sale, if they sell it, is a little bit less. The amount of the gift is more. But a lot of planners would do, how long of a Cupert would you go? Well, I like to go to an 80% chance of it succeeding. So that would be about 14 years, I guess. No. I could go to 17 years. So that, and then a 17-year Cupert, and if they leave early, they get a stream of payments of $474,058. In the 17th year, I look at Cupert 3 here. In the 17th year, the house is worth $20 million. By year 20, it's worth 32 million. So, Jill, anything to add on the Cupert?
The only thing I wanted to, if while you were live, if you click on the columns button under in that section, the one above it, the section above that shows more of the details. Not that one, but the other. If you close that, then go up to the next column button. But anyway, there you go. So show you more if you want it, whatever anybody wants to see on a spreadsheet.
Oh, and that goes into the spreadsheet?
It goes to the top information summaries.
Wow, I didn't even realize that. So the spreadsheet can show all of these things if I just click there. And now the spreadsheet has all that stuff. And then I can export the spreadsheet by going like that. And somewhere there it is on my other screen is the spreadsheet itself. Wow. Thank you very much. No wonder this stuff is so interesting. And then we ran 4 Cuperts, and eventually I think the program will show it in this way. But here you see 4 Cuperts with 4 different scenarios and 4 different answers below. So if you want to, use the software, and I will talk to CPA Academy about doing a self-study course so that you'll be able to spend more time to be able to do this for clients, and should be good. All right, Jill, you did such a great job of explaining qualified personal residence trusts. Now I want to hear about the clat in the hat.
Okay, so this one might be familiar to some people because it was a technique used by Jackie Kennedy Onassis to wipe out all of her estate tax at her death. So charitable lead trust, the difference between that and charitable remainder trust is kind of obvious by the name, but the lead trusts pay a series of payments to a charity at the beginning for a term of years, and then the remainder passes to beneficiaries at the end, all gift and estate tax free if you do it right. Charitable remainder trust, which we'll go to after this, it's just the opposite. It pays to non-charitable beneficiaries in the beginning for whatever the term is, and then the remainder value goes to a charity at the end of the term. So charitable lead trust, because the charity gets the payment up front, if it's set up as a grantor trust during life, then it's disregarded for income tax purposes, meaning the person that puts the assets into that trust gets an income tax deduction for the entire amount they put in. So it's, you might not even want to discount it in that case, because you get an income tax deduction for the entire amount in the first year. Then it will pass estate tax free in the end, but in lifetime you can also set up a non-grantor trust if that suits the needs of the client, where the trust pays the income tax. So grantor obviously pays tax on trust earnings if it's set up that way. Non-grantor is, the trust pays the income tax. The payments, you just play with the calculator to see what works best for the client's needs and their cash flow and their estate tax if they need to reduce, and so on and so forth. But the payments to charity can be structured either to be level annuity payments, and that means CLAT, charitable annuity trust, or they can be a percentage of the assets, or a percentage that may vary each year depending on the trust value at December 31st. Or it can be structured with a shark fin. And I don't know, Alan, if you want to demonstrate with your hands how a shark fin works, but the payments are smaller in the beginning, and then there's a sharp increase at the end. And the advantage of that, if you put them in the calculator and play with that, you'll see that obviously the longer that the assets are able to stay invested in the trust with slower payments out in the beginning, then it grows more, the assets will grow more. So there's going to be more eventually to charity and to the beneficiaries in the end after charity. You can set them up at death, as Jackie Onassis did. And a lot of wealthy families actually use this technique because if they have a taxable estate or they've used all of their exemption and they've given to all the people that they want to give to, then they will draft in their document that any remainder in their estate that could be subject to tax after paying attorney's fees and CPA fees and all of that, then they can zero out any estate tax that would have been payable. I think there's some interesting things differences between the lead trust and the remainder trust. The lead trust can be for any amount, and it could be lifetime. What else did I say about that? It's always out of the estate, and you can use, okay. It doesn't use your gift, so that's the main thing. If it's set up during life, you're not using any gift tax exemption, where in a charitable remainder trust, you are going to use some lifetime gift tax exemption because the charity doesn't get the payment at the beginning, they get it at the end. So there's an actuarial calculation that shows what kind of deduction you would get for the remainder trust. Did I miss anything on that, Alan, on the?
Yeah, here, let me, first I'll clarify some stuff.
Okay.
There is something called a charitable remainder unitrust. I mean, a charitable lead unitrust, but no one uses them because they don't work very well. So we always use charitable lead annuity trusts. There's two varieties. One is during your lifetime. I put the assets in while I'm living. A stream of payments go to charity, and then while I'm living, at the end, something nice happens for what's left. Or a testamentary one, where when I die, it goes to the lead trust, then the term of year payments to charity, then the rest to my deserving family, hopefully. So then if you do a lifetime charitable lead trust, there's two kinds of those. A grantor lifetime charitable lead trust, where you get an income tax deduction for the value, but you pay the income tax on the income of the trust for the term of years. Or a non-grantor charitable lead annuity trust, where you get no income tax deduction, but you don't have to pay the tax. So I'll show you how that works. I have here in my calculator a 10-year CLAT with level annual payments, assuming that the assets will grow at 7% a year and today's 75/20 rate of 4.20. I put $1 million, well, we're going to use 10 million here. So 10 million, got it. So what this is telling me is I can have a zero gift. I put 10 million in, there's no gift, and for 10 years, I will receive $1,245,000 a year. Charity will get a total of $12,452,000, and what will remain for my family will be $2,005,000. Or it could come back to me. So let's walk it through this way. I don't have family. I don't like anyone but me in charity. So I put $10 million in the CLAT, and it's going to go to pay charity $1,245,000 a year. At the end of 10 years, it comes back to me. When I set it up, I get a $10 million income tax deduction. During the 10 years, it's invested only in growth dividend stocks. So I pay very little income tax during the 10 years, or it's invested in a low-cost variable annuity. I pay almost no income taxes for the 10 years. I got a $3,700,000 tax savings, and I got $2,004,000 back after the 10 years. So let's look at it for 15 years. So I go to 15, and now I get the same $3,007,000 in tax reduction, a 10 million deduction, $3,007,000 in federal income tax reduction, and I get $4,006,000 back after the 15th year. but the present value of that 4.6 million is only 2.5 million. So it still cost me $1.2 million. So that is a 15-year clat. Let me go to 20 years. I would have to be 90 to get it back, but now the present value of my future income tax deduction is almost as much as what I get back, and that's a 20-year clat. But it doesn't have to be level payments. I can make it, for example, increase 20% a year. Now, the regulations for GRATs specifically allow you to do this by 20% a year. So I'll click on 20%. Now look at this. The first payment is only $99,000. The last payment is $3.1 million. Now the remainder interest is $12 million coming to my family or coming back to me, and the present value of that is $5.3 million. So if I was younger, that would certainly be of interest, even if I had no family. But now, if I have family and I'm trying to do a clat, I'd like to give charity $100,000 increasing a year to our family foundation, with the remainder going to my children estate tax free. They're going to get $12 million estate tax free in 20 years. But wait, it could be better. I could do what's called a shark fin clat. So if I go here to shark fin, and Jill, could you sing the Baby Shark song in the back? Go. Do, 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 do. You can't do that while I'm describing it. Okay, so if I do a shark fin clat, then I'm going to want to have a little bit of payment there. So I'll pay based on 1% a year of value. So, or let's say 2, because it's sooner. All right. So now the charity just gets $200,000 a year. At the end of the day, it gets $1.6 million, and my heirs get $1.4 million. So, by the way, if I had the children by accident, then they're errors, E-R-R-O-R-S, versus heirs, H-E-I-R-S. There's probably a way to mix those two words up, Josh, for a future presentation. And then, wait, it gets better. What if I put $10 million in an LLC and I donate 99% non-voting member interest to the clat? What is the discount I could take? Let's just say I take a 15% discount. Now the clat payments are lower, and what's left to the descendants is the charity is going to get a present value of $8.5 million. My descendants will get a present value of $7.7 million. That's almost better than paying 40% estate tax and having them get 60%. Here, they're getting 70%, but they have to, I mean, they're getting a lot. They have to wait for it. So Jill, anything to add to the clat?
Can you confirm that can clats or only charitable remainder trusts be named as beneficiaries on IRAs to stretch out distributions to heirs or errors?
Errors, only charitable remainder, only clats. Only charitable remainder trust. It doesn't help with the clat. Okay. But we'll double check with Christy, Nicola, and Brandon on that Monday. They weren't in today. Surprised me.
Yeah, there's one other thing I could add for color, just because we're talking to CPAs here, that income tax deductions are like so attractive to us that if it looks like it might appear that maybe your client can't deduct all that, even though it's a deduction in the year of the transfer. Obviously, it can be carried over for 5 years to offset future income. But another planning technique sometimes is to, if your client has a large IRA and they have this do a clat and get a big income tax deduction in 1 year, that might be an opportunity, if they don't have a lot of income, to convert their IRA to Roth or a portion of it to offset. So kind of get a tax-free conversion so that then the Roth part will grow tax-free.
Super. By the way, there's charts here, so you could play with charts. Like this is a shark fin clat. You see, this is the shark fin, the red thinness, and there's that shark fin. And then on a raft up here is huckleberry fin. All right, so that is the clat, and I should do the last polling question. Well, that's only the third one. Okay, I'm going to do the 2 polling questions now in succession, not having anything to do with that television show Succession, which I have not seen. Do you want to subscribe to the Thursday report? We issue the Thursday report usually every other Thursday, sometimes more, sometimes less. It is free of charge and very mediocre. A, yes. B, I already do. Or C, I would rather have a Spinal Tap. That is polling question number 3. And now we're going to go to polling question number 4. Would you like a PDF copy of 8 Steps to a Proper Florida Trust and Estate Plan, signed by Jill Ashley, and limited numbered editions? This particular edition will only have 38 copies, plus whoever wants them from this show. It will be a PDF personally signed by Jill Ashley, and it will give you the number of the edition that you are receiving. And if you like, it will be in Scandinavian. Josh,
Ready to go.
is anyone left? Okay, many members of our original audience are still with us, showing a very high tolerance or low standards. All right, so here's 3 clats for you. No planning, $68 million, $10 million in a clat, where a lot went to charity, the state tax due a couple million less, and then with a 20% discount. So nice thing. All right, so Jill, we have, and by the way, for those of you attending, at noon, we have one of my favorite all-time people, Chuck Dollenbach. He is the most pronounced tuba player in the world without question. He and his Canadian brass have performed more times than any other classical band in the history of mankind, and he has been on more than 65 record albums and has performed more than any tuba player, and he's hilarious. He was even on the Johnny Carson show. So he's going to be on at noon, and we're going to talk about how to be successful as a professional and as a performer like Jill and her singing. So I'm going to sign off about 3 minutes early. And if you want to, we'll be posting Chuck's interview to, and a lot of you have already signed up for it, but you can sign up for it if you like, and we'll be answering questions later. But Jill, do you want to talk about the GRAT or the private annuity? We do not have time for both.
Okay, not both. Okay, I'll talk about the GRAT since the slide is up. So this is a transfer into a trust. It's a grantor type, so the grantor actually doesn't, they still have control. They don't give up control of the assets. It can't, I don't know if I can do this really fast, but it's disregarded for income tax purposes. So the grantor still pays the income tax on it. You can put discounted assets into it to get them out of your estate. If the grantor dies during the term, in theory, it should be included in their estate, all of the GRAT assets, but it can be easily avoided. It can be remedied by transferring that to in a marital tax deduction scenario, or it can be set up to be zeroed out, like the Walton Grantor Trust. What else can I say real quick? You can have formulas in the document of the trust to allow it to be redetermined, the annuity amounts to Help me out, Alan.
All right, I'm going to show you a GRAT here.
Kids will have carryover basis in it because it's a gift in theory. I can't
Okay.
say it.
All right. You are 60 years old and you know you'll live at least 10 years and you have assets worth $1 million and you put them in a GRAT, and the GRAT will pay you $124,000 a year for the 10 years, and then whatever's left in the GRAT after 10 years is outside of your estate for federal estate tax purposes. So you can't lose anything here, and the remainder interest in 10 years can go to a trust for your spouse and descendants, even your next spouse and descendants, or if you get married and divorced 3 times during the 10 years, even that spouse and the descendants can be the beneficiaries of the GRAT. So for people who don't really want to do expensive or complicated estate tax planning, at least the growth over 4.2% a year can be excluded from their estate using the GRAT. And I just described equal payments. The regulations allow you to have the payments increase by 20% a year. So when I click there, the annuity amount goes from $124,000 a year to starting at $50,000 a year, and the remainder interest is then going to be a projected $312,000. Now the GRAT is disregarded for income tax purposes, so I'm going to pay the income tax on behalf of the GRAT. Its assets are going to grow income tax free because I will pay those taxes. And then let's say the IRS comes in and says, hey, you did this GRAT. You said that that property you put in the GRAT was only worth $1 million. We think that that property is worth $1.5 million. Well, there's no gift tax due. The GRAT statute says that if that happens, the annuity amount is grossed up. So in my example, the first annuity payment would be $75,000. So the IRS cannot get a gift tax, cannot get a penalty from the GRAT. So that's the basics of the GRAT. Under advanced, I could also put in discounted assets, and then my payments will be even less and there'll be more value left in at the end. And if you have a business that shoots off a certain amount of income, you can put that into, see annual distributions there. If this business is worth $1 million, but I discount it to $700,000 and I know it shoots off $200,000 of dividends, then look at this result. I've made no gift, and at the end of 10 years, there's $4,485,000 left in the GRAT. So they're really good for S corporations and partnerships. All right, Jill, we're going to close off here. I cannot thank you enough. You did a fantastic job. Thank you to the audience. I am sorry to the mooses in Scandinavia. I did not realize that it was Norwegian that the mooses speak, and there is no Scandinavian language. So I appreciate whoever told me that. But speaking of mooses, please join us with Chuck Dollenbach in 2 minutes. That's 2.2 metric minutes, and have a fantastic rest of your weekend. Bye.
Sir. All right.
How we do? Good.